I'm very excited to be here speaking to you at this Investor Summit. So what I'm going to speak about for the next 20-25 minutes is about diversification. So while we always talk about diversification, what exactly is diversification? And we think of diversification as a very boring tool that we must do in investments, but most of us never do it. And the idea of running through the presentation is show that diversification is not just about preservation of wealth, but it can also help you create more wealth. So let's take a step back and see. The last few years, we have been in the middle of a tremendous bull run, right? And as Krunal said earlier, equity markets have created tremendous wealth for most of us here. So if you see, not just in India, all other indices, I mean, they've had a phenomenal run the last 4 or 5 years. And Nifty has been one of the best performing markets. So what does that mean, right? All of us here, across asset classes, we have made wealth, but most of that has come from equities. Now, going to the next slide. So as we have created wealth, it's very easy to say, okay, I had 100 rupees in 2004 or 2014, now I'm sitting on 600, 500, 400 rupees. Now that is one thing that can make us very happy. Or how do we now preserve this wealth of 400, right? Only when we preserve this capital will it make sense that we made this capital in the first place. So as we ride this equity wave, there are two things that happen, right? Number one, equities are highly cyclical. So you don't want to just ride a wave like go from bottom to top and again come back somewhere in the middle. More often than not, you will hear at the end of a cycle, people say, yes, I had X and I went to 4X, but I came down to 2X. That doesn't make any sense. Let's go back. Can we go back? So one is, don't just ride the wave. And number two, typically in equities, while it is proven to be a wealth creator tool over a long term, in the short term, it's very, very volatile, right? So if you go to the next one. Now this is just Nifty, and we have tried to show how volatile it is. So talking about volatility, if you look at the last 1 year, right? So every single day or over 3 years, 5 years and 1 year, while some of your investments may have gone up or may have gone down, but they didn't go up or down in a straight line. It was up one day, down a little next day, maybe up 3 days again, down another day. So that is volatility. And now what volatility does, why we are talking about volatility is what volatility does is, because you can't predict it, it is nothing but an inconvenience or an added expense. And a lot of money managers, how they look at volatility, they will say, oh, well, things are on the way down, buy some more, buy some more. That works in an ideal world when you know that you will fall for the next 5 days and the 6th day you will go up. What if the 6th, 7th, 8th day you are still falling? That buy more on a volatile day doesn't necessarily hold true, as appealing as it sounds. So the idea is volatility is not your friend, it is an added expense. How do we handle volatility? So what causes this volatility, right? So some of the events which cause volatility in the last 3-4 years. So every time we have a state election, right? You will see like markets are having these wild swings. I remember when we had the Gujarat state election, I think intraday Nifty had opened positive, went down, again closed in the green. That's nothing but about what? 600, 700 points of intraday volatility. That's a lot. And I'm sure a lot of people lost money in that volatility. That loss is something which we could have planned better. One other event which led to volatility was demonetization. Crude prices, right? So just a couple of months ago, when crude was up at 90, markets were falling every day, then crude stabilized, retreated back, again we started doing better, right? So these are some of the events, big events which caused volatility. Brexit, again, that was an international event. So the idea is we have domestic events as well as international events which is causing volatility. Looking forward in 2019, what are some of the events that may cause volatility? So we have the big national election. We also have tariff war, right? Anytime you pick up any of the large newspapers today, there's an article about tariff war. US trade relations with China, China trade relations with India. And while these things take time to play out, in the short term what they cause is volatility. Nobody can predict how it will be tomorrow or day after or next week. Next. So now, when we talk of diversification, right? So what I've tried to do is, in the first few slides, we have just presented the idea of how you have created wealth and why diversify. So now when you go to a typical investor, your money manager or advisor comes to you and says, okay, let's diversify your portfolio. What do most people do? So this is not true on your balance sheet, but this is true for most of your fresh inflows. So you will take, this is typical allocation. You have 5 to 10% in gold, I'm starting from bottom. Real estate is another 5 to 10%. Fixed income, these are basically various debt instruments, that's 20 to 30%. And that's your return. These are last 1 or 2 years of return. So let's say a typical investor, he has a mindset or his target is कि अपने को 12 से 15% return करना है, right? So if you look at on your entire portfolio, 12 to 15%, which is a very moderate and achievable return over a period of time, if you were to target that number, and these allocations are true, which is what an aggressive investor will hold, that means on your equity portion, which is 50 to 60%, your equity return should be 16 to 20% for you to get 12 to 15%. So if we take a step back, that means that's a very aggressive outlook on your equity. So we will, I guess in a couple of minutes, we will have various equity fund managers join in, and these are numbers which even they will admit is a very aggressive number. You will hit these target returns in your equity portfolio 1 year, maybe 2 years, but not year after year. Nobody has hit those returns every year, year after year. So if you are an investor and you are following this model, you are diversified, but let's go back. You are diversified, but the two risks you run is you are taking disproportionate risk on 50 to 60% of your portfolio to generate outsized returns, and you have a risk of over allocation. The idea is you think, okay, I need to keep pushing for that 12 to 15%, let's keep putting everything in that big bucket. That is nothing but over allocation. Do not fall for over allocation. So I want all of us to take a minute more on this slide. This slide is very essential. This is the foundation of why diversify. And the 2 points I want to run through this slide is over allocation and disproportionate risk. Next. 20 year, 10 year, 1 year. Now how has Yale generated these return year after year? Look what they are doing. None of their asset classes is more than 20%. No matter how much money they are making in something, they cap it off at 20%. And they have everything. It's not that they love US stocks, so everything is US shares. They have everything, and what they do, they don't go overboard in any of those items. Remember the last slide when we were talking of over allocation. There is no over allocation here. So this is what a smart money ideal portfolio looks like. And this is a real portfolio. This is not a computer generated portfolio. This is real audited portfolio of Yale, which is Yale Endowment Fund. And this is $25 billion of portfolio. So it's not even like they took a small amount of money and generated this return. the idea is, so in the last 20 years, the world has gone through 4 or 5 large cycles, right? So there was the IT bust, then 2008 when US went through the recession, all those. But Yale has come out of all of these without losing capital. And they have only done that by diversification. So one of the things why we like to talk about diversification as a team is whenever I read this, I have this app of money control on my phone, and I often go through some of the articles. And the big focus that I've seen, a lot of these articles, is they all focus on creation of wealth. And I guess because we are an emerging market, the idea is that let us create wealth and ride the wave. But none of them talk about preserving wealth. When was the last time any of you read an article by a money manager that, hey, you've made $3 million or 5 crores, let us preserve this wealth. Everybody is talking about how to make the next crore. And as your portfolio increases, right? So let's take an average investor. Let's say you were invested with some of these very good fund managers and you've created amazing returns on your portfolio. So let's say you had 1 crore in 2014, you were invested in an amazing PMS product, and now you went to 5 crores. The same investment strategy which helped you grow from 1 crore to 5 crores, if you deploy the same investment strategy, that will not help you grow from 5 crores to 15 crores. It's not linear. It will never work. You will either stagnate at 5 to 7 crores or you will lose money. So that is where diversification comes in. You need to, as you create wealth, let's spend time, diversify and preserve wealth. Let's go to the next slide. Our idea is, all of us, I'm pretty sure most of us in the room, when we talk of diversification, a typical HNI will hold stocks, direct equities, some through mutual fund, PMS, various debt products, maybe an FD, maybe a debt mutual fund, real estate, what else? I think I've covered everything. Maybe some private equity. All of these in India, they are all rupee denominated assets, every single one of them. You are writing out a check in rupee, your investment gets locked in rupee terms, and when you redeem your investment, it comes back in rupee terms. So these are, while you're diversified across asset classes, you're not really diversified. So what is the next level of diversification? Our belief is diversify a small portion of your wealth, a very small portion, into a dollar product. Make dollar your friend. And dollar needs no introduction, it is the global currency. Even today, 62% of global trade is dollar. In fact, while I was making this presentation, me and my colleague Prosenjit, we were working on data, and what was very interesting was that central banks across the world are buying more dollars. So the dollar is here to stay, and make dollar your friend. Next. Now this slide, this is a slide, I love this slide personally, and this is what I call the power of zero. So in the last 10 years, the rupee has lost 50% of value. These are real numbers. 50% of value vis-a-vis dollar. What does that mean? So obviously, each one of us has created wealth in the last 10 years, right? Varying amounts of it, but each one has. So this slide essentially means whatever you've made, right? This is nothing but a hidden tax. You are not richer in real terms. So as I meet investors all over India, one thing I realized, so we came to India a couple of years ago, and I'd meet investors every weekend or some of the weeks, and people would say, "Arey, मैं 20% बना रहा हूँ, 25% बना रहा हूँ." I think nobody makes 20 or 25% on their entire portfolio. Maybe they do it 1 year, maybe 15 months, but not year after year. Nobody would go to work if everybody made 25% CAGR. Nobody. I would not be working. I don't know about you, but I would not be working. So this is nothing but a hidden tax. And as your portfolio grows, it's not really growing. This is how much you've lost in the last 10 years. So again, the idea is, as you diversify, right? So we are in the middle of a bull run in India, and these are the indices I've picked up, right? So in rupee terms, these are the returns you would have made. Now the idea is, as you go far along, right, you start going back and back. So now coming to this, right? So let's say you diversified a little bit in a dollar product a couple of years ago. So the first year, so when we came to India, right, let's take a real example. I think 2016 is when we forayed into India, 2015, 2016. So the rupee was rock steady, it would just not move. And some of our initial clients who were investors at 65, I remember, rupee had touched 64 or 63, they called me up saying कि boss, आपने तो बोला था 67 हो जाएगा, अभी तो 63 हो गया. And they used to call me every week. Literally every evening they would call me like an alarm. So that year the rupee didn't move. It just didn't move. The next year it moved just a little bit. But look what happened this year. So if you look at this year or the year that just went by, equity markets did not do well. And they were extremely volatile. Currency took a 10% hit. So if you look at an average investor's portfolio adjusted in currency terms, it's much worse than what your account statement would actually show. But now, that is when diversification actually kicks in. That rupee investment that you locked in at 63, 64, 65 has given you that 10% bump. So the idea again of diversification is a small portion of your portfolio will not work every year and give you that alpha, but it will work every few years and smoothen out the rough curves. Next. And just one more thing, right? So another thing that I keep reading about is, and I see this in emerging markets a lot, and especially in India, we get so caught up in this quest for alpha, and everybody talks of how much alpha they have generated. Nobody realizes that beta has actually killed alpha. Nobody talks of beta. Nobody. So in this quest for alpha, we are just losing the essence of capital preservation. The last thing why we believe dollar will remain strong this year. While people have varying opinion on how good or bad Trump is as a president, the US economy is clocking in very good numbers. They seem to be doing 3% plus, and that's very good for the dollar. Second, right, if you have a risk-off year and most of the money is getting into risk-off, that means a stronger dollar. Again, as you diversify into dollar, I don't know, today the dollar is 70.5, right? Tomorrow it may be 69, it could even be 68. The idea is not that it will be now 71 tomorrow, but over a long period, diversification helps. And again, when I talk of diversification in dollar, somebody once asked me this very interesting question कि आपको नहीं लगता Indian economy अच्छा कर रहा है? Because people often tend to mistake me that India is not doing well, hence invest in dollar. Our thesis is totally different. In fact, we are extremely bullish on India and how India will do. And hence, as you ride this wave of India doing better and create wealth, that is where the need for diversification is. So, in fact, we are so bullish on India, we've clawed back. So, we used to be in China also. So, we have slowly clawed back from China as a country, and put our entire focus on India. So when I talk of dollar diversification in the Indian market and to this extent, it doesn't mean at all that we are not bullish about India. We are extremely bullish, and hence the need to diversify. About us, we are a US-based investment management firm. We've done about $300 million of transactions. Just as there is SEBI here, we are all under SEC, which is Securities Exchange Commission, headquartered in Dallas. In India, our head office is in Mumbai. We also have another office recently opened in Ahmedabad. So out of dollar diversification, we've got two products that we are pitching to investors in India. One is nothing but an immigration product, which is EB5 for people who want to get a green card. So it's only immigration. And the second is dollar denominated investments. We've traditionally done a track record of